Hi everyone. Today is Wednesday, May the 7th. My name is Anne Marie Band, and this is defining risk using market structure across time frames. For many of you, you know who I am, and what I do want to say is it's probably a good thing for us to, if you do, whoopsie, wrong one. All right. Of course, it always happens here. Here we go. It's a good thing for you to put your questions in the Discord chat. That's going to be the best place for you to have questions for me, or you can DM me on it, whatever platform you are used to. So we are going to get started. Want to make sure that you can all hear me and that you can see the screens. Just give me a heads up there. Let me know that we're all good. Yeah? Okay, great. Wonderful. Thank you so much. All right. So this will be available for you. I'm also going to put it up on YouTube, and we'll be talking a lot about enforcing these. Last week we did a session on, working through that journaling of events, having a personal mindset, but very difficult is creating that mindset when you don't have a structure that you can feel confident in when you're trading. And so that's what I want to work on today. Let's see if we can get those things really set for you so we can move forward. All right. So for those of you that don't know a ton about me, which I don't know how many folks that is, but there are a few of us that might not know. I've been trading about 20 years, really very actively, about 20 years, and have been trading full time for about 20 years. I just jumped headlong into it, made a lot of mistakes, and one of the biggest mistakes that I made was not understanding how to define risk. And so that's really what we're going to talk about today. So, what is risk management? So, if you look up Merriam-Webster or any other kind of space that you're staring something down, you're going to notice that risk management is a systematic process of identifying, analyzing, and responding to risks. The goal is to minimize the impact of negative events and maximize opportunity. That's what we're supposed to be doing with a stop, right? The problem is most of us don't do that. One, we don't do it systematically. And the goal of impacting negative events compounds when we don't use a systematic approach. Just the other day, I bumped into someone, actually they were in the Discord, and they said, I normally use 20 tick stops for the NQ or ES or whatever, and I find myself getting stopped out a lot. So here's the most important thing to know about risk. Risk has to be defined relative to the overarching of where we're sitting. So first of all, if I am here in Florida and I read, hey, it's going to be cold, Florida, right? I hear it's going to be cold, but I leave home without a jacket. And I know I have to be outside, walking from one place to the next. Let's say I'm walking in from my car to a store, okay? I can run in. But if I'm in the middle of the frozen tundra, if I'm in Antarctica, and I'm inside of a vehicle, and I have to walk from inside the vehicle to another store or some kind of whatever place I might have that I would visit down there, I could easily get hypothermia and die from exposure to cold. So that's an outlandish example, but it does tell you the core impact. And the core impact is, one, you can't just say, hey, I'll just take a light jacket and I'll be fine, i.e., I'm always going to use a 20-point risk, because the market might not be telling you that's a possibility. That's very important for you to grip. So, core components of risk. We have to identify potential threat or uncertainty, and again, threat of a major loss or threat of a loss that you are going to feel uncomfortable recovering from. Risk assessment. How likely is it that it comes into that area? And if it does come into that area, then what? We'll talk a lot about stop movement in this space because stop movement actually does less for your long-term opportunities than you might realize. Now, if you're using multiple contracts and you're saying, hey, I'm going to take half out and I'm going to leave the rest at break even, if you've got a very tight cycle, that might not be a bad idea. If you're trading counter trend, that might not be a bad idea. But you've got to have a good idea of risk assessment. Risk mitigation. How do we develop strategies to reduce or eliminate risk? We're going to do risk mitigation before we enter a trade, not after, right? Before we enter a trade is going to be ideal. As your skills develop, you're going to be able to do risk mitigation after you enter the trade. But that is more of a complex option sort of thing. Some of us work together with me on these option spaces. Most of us don't. So that is something we're going to consider before we enter. Risk monitoring. Now, this is market-generated information. If something happens that you do not expect, that's going to tell you, maybe what I thought the environment was isn't quite going to be that. I see storm clouds on the horizon, right? That's like driving, I said this the other day on Lunchbox Trading with Dee and Hogue. I said, hey, it's sort of like driving down the road at 70 and then all of a sudden you see a rainstorm off in the distance. You're not going to drive into that rainstorm at 70, especially if you've got your children in the car or your grandchildren in the car, whatever it is. So you track risk continually, and then risk control is going to be about sizing up. A big problem, and next week we're going to talk about a strategic way to build into a trade and consider sizing into the trade relative to what you are looking at. And I'm going to teach you what the sunshine skies look like, what overnight skies, over cloudy skies look like, and when it's, thundering and lightning and you don't need to be outside. All right, so we're going to go through this. Why arbitrary stop losses hurt trading performance. Risks of non-systematic stop placement. A lot of times we go into a trade and we don't know how to mechanize it. And so what do? We pick an arbitrary stop. Oh, this looks like, I think I'll just put it at that low there, or I think I'll put it up at this high here, without an understanding of what the broad structural market looks like. So here are the top reasons why arbitrary stop losses don't work. Mismatch with market context. That's what I mean about going out and cold being 40 degrees versus cold being negative 80 degrees or negative 120 degrees. Arbitrary stops ignore market structure and volatility. And so we're going to be looking at, what does market structure really mean? What does that word mean? The next one, frequently hit by normal price fluctuations. This is what happens when folks go, well, I'm only going to give myself a 10-tick stop. Well, if the ATR, the average true range for the day, is 40 ticks, and you keep getting in trades using 10-tick stops, you're going to be smashed. Absolutely and completely smashed. The third thing is premature exit despite valid trade thesis. This is going to be, I'm going to move my stop way up here because I don't want to go backwards and da-da-da-da-da, right? So mismatch. That's why arbitrary stops. And by arbitrary, I mean, I'm just using 20 ticks. I'm just going to always wear black, which I often do. My husband tells me, please stop wearing things like you're going to go to a funeral every day. But I'm very comfortable in black. Today, I'm wearing a bright and shiny color at the request of my husband. All right. Next, it breaks your risk-reward integrity. So what does that mean? If you have a 2 to 4 or 1 to 2 or a 1 to 4 or whatever it is, and you get into that trade and then you move that stop, the way you compile your data to go, how effectively am I trading? It's going to throw everything off. Inconsistent stop distances distort risk-reward ratio. Consistent ones that don't match market structure also distort risk ratios. It can lead to risking more than the potential reward, right? Oh, I'm just going to move the stop down just a little bit more because I think it's going to hold. Undermines long-term profitability in general, okay? The next one is that it encourages emotional trading. Now, this one I really want to camp on for a hot minute because a lot of us trade emotionally because we cannot understand general market structure and what we actually need to do. We always have this thought of, uh-oh, what if I'm wrong? What if I put my stop in the wrong place? How do I? So that, we're going to nip that in the bud over time as we practice finding market structure and learning how to adjust stops. Stops based on fear or recent loss streaks, huge. It leads to over tight or over wide stops, and it reduces confidence and discipline. Listen, confidence and discipline are huge pieces of why it is that a trader is able to get into a trade and stay in a trade. If you don't have discipline, you're never going to be able to hold yourself to task. It's like saying, hey, I want to change my body fat composition, so I'm going to go on this macro diet, but then every third day you decide, you're going to eat a bowl of cheesecake or whatever, right? You're going to undermine your ability to perform. And when you don't have self-confidence, it's going to yield itself to a crisis event every time you trade. Okay? And so we're going to nip that in the bud also. The next thing is that it disrupts strategy consistency. So here's what I notice. A lot of us don't have trading strategies. We're going to discuss the one that's most effective for me next week and discuss ways that you can take the framework of what it is that I'm sharing and create something for yourself. Trading is an individual performance event. Very individual. You simply have to sit and say, what works for me? Do I want to trade a 1 minute? Do I want to trade a 5 minute? A lot of times we trade a 1 minute because we're scared of losing. We just want to get in and get out, get in and get out. Nothing wrong with that. But the stronger you are in building a consistent strategy, the more comfortable you are sitting in a trade for hours, like I did when I was on fast markets on Tuesday. I was literally in that trade for hours. It didn't get to target until, 12:30, 1 o'clock, something like that. And so that's super important. It's also hard to evaluate your effectiveness if you're a scalp trader and you have to individually look through 150 trades on the day. So why am I talking about that? Because last week we talked about journaling and the power of keeping track of how your performance moves so that you can incrementally benchmark yourself on the way to higher levels of performance. If you can't embrace that, you have to look at yourself in the mirror and realize, hey, I'm either going to be below average or average. Doesn't matter how smart I am, doesn't matter what I do. If I'm not consistently improving and consistently assessing each event I participate in the market, I am not going to get better. I'm going to be average. And as the stats show, I talked about this last time, 5%, less than 5% of traders succeed in the markets. Less than 5%. So think about that for a minute. It is supremely important to take that on board and go, listen, for somebody like me, I go, bring it. If you're the person that goes, that scares me, chances are you can do it anyway. But what you have to do is get to that space where you say, I am really going to work on what it is that I am doing. I might not get to the top of the heap, but I think I can get to the top 20%. I think I can do better. Now realize that the stats show this because most people have no consistency in strategy. I think that Jack on Top Step TV put up a snippet the other day that said, or it might have been Dolby, I can't remember, people spend less than 5 minutes before entering a trade. They spend less than 5 minutes going over the strategy for the trade before jumping right in it. I have to tell you, I have been there. I have done that. Somebody said, oh, I'm long, and I go, ooh, I like that person. I'm going long too. Bad. Very bad. And it took me losing a lot of money to realize I simply had to stop doing that and putting myself in another basket that said, you got to measure how you move, and you've just got to get better at building strategy consistency. The last thing is that it increases false stop outs. How many times have you raised your stop and then noticed, oh my gosh, you know what? That thing is going to run without me. I got to tell you, 100 times for me. Literally 100 times. Maybe 1,000 times. Small losses without catching trends, triggered by an intra-bar noise event. You know, people call them tape bombs, whatever. I promise you, the market tells you when tape bombs are likely. And I'll show you that too. Leads to death by 1,000 cuts. We know that very, very well. Okay, so what we're going to work on right now is looking through market-informed stops or market-generated stops, right? And let me see if, here we are. How markets define proper stops. And we're going to go over this concept of market structure. So what does it do? Price defines trends versus highs and lows. Oh, that makes sense. I know what you're talking about there. Identify uptrend, downtrend, or range, and analyze structure based on entries and see where the trade biases might sit. All right, now we are going to go to Zoinks. Let's see. Click. All right, so here we are. I'm going to put this on full screen so we can see just the charts. And here are the formations that I use. First, we're going to look at an hourly chart, right? I've got Hoag's top step daily levels. I think they're automated now, but Hoag designed them, of course. And what I think I want to start with is I want to remove all the indicators, okay? We're just going to look at price. And so I'm going to describe to you market structure on an hourly time frame. So the first thing is you look for a swing low and a swing high. So maybe you want to start over here. Let's start over here so we do it. What's the easiest thing to do? You want to draw, let's see if we can get ourselves a box. Can we get a box? Yeah, let's do a Gann box. All right, we're going to go low to high. And I'm going to change how this Gann box looks because we don't really care about anything at all in this box. We don't care about time at all. We only care about price. Okay? That's all we're staring down. And let's make the background color very small. Yeah. What's this? Let's make this gray. Nice and easy. Okay. So what this gives us is a swing low and a swing high. And it tells us the following. The market has defined for that swing low, and we're going to take it all the way across to see how these moves behave. So here we are, it's moving up. So we think to ourselves, ooh, this might be a trade I might want to take. So I'm going to add an indicator, one indicator because we do need it. We need at least one thing telling us about trend. And so I'm going to use a moving average. And because it's a 1 hour chart, I'm going to, I think this is a 14. Oh, it's a 9. So let's make it, no, let's leave it a 9. Doesn't really matter. I want to make it be a little bit brighter so that we can see it. Right? Market structure and trend are the two things that are going to tell you what's going on. So this is the low of a range and then the high of the range. So the question is, price action moving up. Ooh, I wonder if the pullback is going to give me a buy point. I can see over here I have old resistance, right? So that's certainly something. But the halfway marker in a structure break is very important. So if a candle closes underneath that zone, your thought should be, uh-oh, it's going back to the bottom of the market structure. That idea gets confirmed when it falls under that moving average. Now, you might say, Emery, I don't use a 9 moving average. Why don't you use a 14? Fair enough. I'll use a 14. Same difference, right? Two things happening here, though. We get extension away from a moving average that does not have tremendous slope. So you know it's likely to pull back. And then you have the bottom of the structure break. Now, when a structure breaks, it actually begins a new structure. And what we have to decide is what time frame do we want to trade on? If some of us say, listen, I can't hold a trade for 4 hours. I have to go to work. I spend 2 hours a day trading. I want to get in, get out, get my trade done. That's fine. Hours not going to work for you, but it's important for you to see what the broad structure is. Okay? So notice what happened here. When this broke, when this market structure broke down, when it lost this area, we can go, let's clone this. All right? We can take the one that just got moved, and we're going to create the new wave that went all the way down. So you might say, here's that low. And I'm going to bring it, we know that the top is here, okay? That's where this high comes from. That's the high wave. You might say, well, why can't I trade this breakdown? Oh, you absolutely can. As long as it's below your 14 and it's broken structure, it's actually going to move into old structures below. Have a look. Look at this piece of structure that it broke into. This is the actual area. Now notice, wicks, don't rush on in, folks. Let price action resolve in the area. Wicks are just that. They're wicks. Somebody is going to be the guy or gal that goes, oh my gosh, I sold the low. I've been the person that sold the low. I've been the person that's sold the high too, but I've also been the person that's bought the high. So this just happens. But this breakdown from this area begins to retrace the old market structure that's sitting over here. And so we can do that GAN box again, and we can go, all right, this is my box that goes, you know, if you want to take it to where the candlestick bodies are, if you make it on the wick, you can see it runs right back into the old space. You're going to notice this time after time, unless a chart is making a low below its IPO low or above its new high, and then it's going to time frame up. You've heard the traders talk about that in a lot of different spaces, right? When we time frame up, it means we're continue to make higher lows and higher highs, all the way up. Okay? So, 1, price structure is a real thing. 2, it absolutely tells you where key areas of support and resistance are. But also, it doesn't tell you, hey, just go there and put a limit order at this space because this is what you're doing. But when it recovers, then you're in good shape. I like to build trades on the 1-hour market structure because it helps me understand what's going on, right? Works for any chart, in any space, in any way. For those of us that trade the NQ, we'll be doing the NQ next week. I know a lot of people like trading that NQ, and so we'll be working it on minor time frames. But my goal first is to describe market structure and then talk about risk relative to the structure in play. All right? And so today, if you watch my morning report, I said, listen, this opening range candle tells me that we have risk across the board, which gives us a lot of wicks. And of course we did. We sat around and did a little bit of nothing, and then it broke, and then it held. And so I said to folks, I said, listen, you want to wait down at the bottom for a trade long or up at the top for a trade short. That's what's going to happen, because notice how many of these structure events overlap each other. because the market is doing what it's doing right now, and isn't that a crying shame? I can't, oh, I need to move it out this way first. Let's try that again. Because the market in this big sideways patch, we have structures that are overlapping each other into the spaces, overlapping into the spaces. Okay, so now we see how a market structure works on a 1 hour, right? And here, look at how many different breaks we have. We have a break here that gives us a high to a low, and that's exactly where we closed in this mid-range. We had a break here that gives us another event from high to low. And then we have the big one from the Fed speak, which gives us high to low. When you've got price action that you can see, one, piano keys, candlesticks retracing each other, and two, structures that sit and compound inside each other, it is telling you the following. Wait for the edges to make a decision. Now, the question might be, but Anne-Marie, there's so much money to be made in between here. The answer is yes, there is, but at what risk? And this is what makes the short-term trader get themselves into a ton of trouble. So now, what we're going to do is pretend you don't have any understanding of what's going on here. And we're going to pretend that the MES is actually the ES. The rhythms are exactly the same. But instead, we're going to do something like, I don't know, what do we want to do? Let's stick in the 5-minute chart. And what I'm going to do is remove indicators, right? And now we're sitting here with nothing but price action. And we begin the day. Let's add the moving average here. Add this indicator too. Okay? Super choppy, but you decide you're going to trade it anyway because you know you can make money. All right? 5-minute chart, opening candlestick formation. We're going to do the same kind of structure breaks, right? This is the opening range candlestick, but this area below here is the swing low. So this is the area we're going to draw the box on. Still a 5-minute chart. Low area. Because it's the first hour, I think it functions through the whole day. I know a lot of old-time traders, old-school traders like to look at 9:30 to 10:30. The world trades way more than that, and so it's very important to look at the Globex Open. You're going to see a lot of price action, do a lot of things. So, big range. So you might say to yourself, you know, I can trade inside of this big range. I don't have anything messy. I mean, I can do it, I can do little moves, okay? If you are staring down a formation and you go, okay, all I'm looking for is market structure break. I know that structures can sit inside of structures. So the first one I want to see is this one, early in the morning. And here is my high to my low. And I don't know how far it's going to go, but that's what I'm going to do. Remember, the 50% line in that range is pretty important. If you lose it, you're pretty likely to head to the bottom of the box. But let's say you decide, oh, look at this, trend break, I'm going long. Right? And you think it's going to break to the highs. Market structure here tells me that if you enter at, and let's get a trade position here. If you look at this and you go, okay, I'm going to enter at this breakout area because I'm above my moving average, and this is just what I'm going to do. So let's say you take it at, the break of the high or whatever, and you think you're going to the top. Risk in this environment says that it's got to be this wide, or at the very least, an internal structure which is not as significant unless it's breaking out. Unless it's breaking out of the range, right? If it's breaking out of the range, a pullback to the mid-structure, perfectly fine. If you try to take it and go, hey, I'm going to be here. Let's say you go, you know what, I'm just going to give myself a 10-point stop. Well, you're in great shape there. you're in great shape. One, because that's a bad setup in the first place. And two, you're sitting in a space where risk is so wide that if you did sit out of the trade, you would really have your loss sitting in a very big space. So let's say you decide you want to, let me move this in the other direction. Oh, it doesn't do it for me. Let's say your goal is to actually, good heavens, what did I do here? What a knucklehead. Operator error here. Hang on, folks. Let me get this straight. Long position. All right. There we go. All right. So first thing, you're going to be in good shape if you are looking at the bottom of a range and you say, you know what, I think it's going to break above that moving average. Never mind whatever anything else is happening. If you say, hey, I'm going to pick the bottom because I think it's moving up, the market structure tells you you've got a shot there. But if not, it's underneath the 50% range of the bigger cycle. Okay? So if it moves up and you go, okay, I'm going to take it up to here, you're doing just fine. You can get out of the trade. But here's the better way to think about risk management. The better way to think about risk management is the following. Am I getting in a space where my risk is limited and my opportunity for success is outsized? That's how you manage risk, really. You think about the overall environment before you step in with your stop. It's sort of like saying, let's say you've got an 18-year-old son, and he comes to you and he goes, hey, I was thinking about making a commercial lemonade stand, and I wonder if you could, loan me 50 grand for it. Assess the risk. That's the whole environment. Now, if you want to teach your child a lesson that's going to be one in hard knocks, then you might say, hey, why don't you go to the bank and try and borrow that money and then see what happens there. But the point I'm getting at is if you don't first look at, wait, what's happening, you're going to likely get into trouble and your trades are not going to give you what you're looking for. Okay, so for me, my thought was, with this opening trade range, I'm either going to go to the top or I'm going to the bottom, and I'm very likely to bounce. So what am I going to do? When it gets to the bottom, as it does here, I've already planned this trade. I planned this trade at 5 a.m. the morning of. So now that I'm here, my thought is, okay, what do I have to do? You guys who work with me know I say the same thing. 1, wait for it to stop heading lower. 2, watch it break resistance. And 3, watch it pull back and make a higher low. So how does that look? That looks like this. 1, fails to head lower. That's the low right there. 2, breaks resistance. Resistance is the bottom of the opening range. 3, pulls back and holds the low. So now I'm looking at this candlestick and I go, you know what? I'm taking a long right here. And so here's my long position. And now what do I have? I have a clearly defined market information generated stop right underneath it. Okay? That tells me that I can have my risk all the way at the bottom. Now, the great thing is you can have your risk all the way at the bottom until it starts getting into these top edges and creates a new structure, and then you can continue to move up. But my thought would be, hey, I'm going to take this trade. I think it's going to go here. I hope it's going to go up here. But my goal is to say low risk, high reward. I'm going to go into the first structure break. Notice the moving average is down. But I've been waiting on this rotation all day. So what the moving average down tells me is, no, don't get your knickers in a twist all hot and heavy to move all the way up there in one fell swoop. Not going to happen. Downward formations, especially like this, they're going to try and come back and retest. I always say the market participants are neurotics. We're always turning around to see if the door is locked behind us, and that's retesting that low. You could move into the first structural base, get out completely, and then leave that setup right there, and there are 2 more times that you can take it before the day is done. It's right at the edge, minimum support. You framed it out on that 1 hour time frame, and you can walk it up in those 5-minute edges, and all you're doing is saying, okay, where's my last market structure break? And here we have this high, low, lower high, lower low, lower high, lower low. So each one of these is a structural formation you can use, so you know the edges that you're looking for to target are based on these breakdowns where you can move your chart into. Sometimes it wiggles, gives you a hard time. Sometimes it goes directly to target. Sometimes it blows all the way out, but what will keep you in the right frame of mind is understanding the big picture structure from a 1 hour perspective. If you do tight trades, right? I think a lot of us are a little uncomfortable about how we sit in a trade, how long we sit in a trade. We don't know where price is going. We don't know where support is sitting. Just remember this. A stop needs to be underneath the break structure because they could come in and test your wicks. More than likely, though, especially if you collapse down into a tighter time frame and you go, okay, first, I got to stop heading lower. Second, I got to break resistance. Sometimes you do it in the same candle, both the higher low, and it breaks the resistance zone, which was the low of the opening space. Then you're going to look at the candlestick that closes above your range, and then you're in like Flynn. Very next one, you can put a buy stop in there, where it buys as soon as it hits the target, because you've already estimated that risk. And as it moves up, you can go, once this moving average changes direction, I'm going to be able to add once I get up over it, right? Walking into the different frameworks. And that's exactly what this thing did. It moved time framed up here. Here's the low, here's the high, here's the higher low. Here's the low, here's the high, here's the higher low, just retesting the low, but it's still giving you upward structure. And so here's the low, here's the high, and here's the higher low. And so as long as you're walking yourself into targets, notice if I draw the structure, take a look. It's always going to give it to you. Listen, I am a well-educated simpleton. I'm just going to be completely factual with you. Well-educated, but truly a simpleton. I love to look at pictures to tell me what to do. This is the first structure break off of that big candlestick formation. And I'm going to move it all the way over to the edge of the day. So that's the high, that's the low. Look at where it comes into, the 50% marker. I know you're going to say, what? But I'm telling you, this is a structure that works all the time. Could it wick over? Yes. Could it spend a little time over and collapse? Yes. You just have to look for the market-generated information that says, I was going to take it to the top of there. It does show me a breakout, but my risk is really big if I hang on to this trade. If it doesn't go right away, I'm out of here, right? That's what you have to say. So here's what we have. We have how to draw risk structures. Realize that market structures define the appropriate market-generated risk that you need to put in your position, right? And then we can talk a little bit about sizing and risk parameters and those sorts of things. A lot of times, and let me see if I can pull my let's take a peek at risk management frameworks. Okay, so now you know how to go find them. It's as simple as swing high, swing low, swing low, swing high. All right, now a couple of these kind of bigger, right? So this risk management framework, this data I got was the standard for accounts that stay positive. What do they do in terms of risk? Well, 0.05% to 1% of the account. So let's think about this. Let's say you've got 100K, let's say you've got a 100K prop account, right? The drawdown is, what is it? 2,500? I don't remember. What is the drawdown? What EMA am I using? It doesn't really matter. Pick an EMA that you like. It just better not be too tight. You need something big, and because you don't care about what that EMA actually is. What you care about is the shape of the EMA. Is it moving up? Is it moving down? Is it chopping through everything that you're looking at? So what is it? And forgive me, my brain is making me forget what some of these drawdown limits are, because if we have prop accounts, if we have prop accounts, we have drawdown events, and it says, hey, you've got a 50K account or you've got a 100K account, but really what you have in your account is just your drawdown. So essentially, if you've got a 50K and you're trying to risk 1% of that account and your drawdown's $2,000, that's, what is that? $20? So that's not the kind of risk we can use here. We have to use outsized risk to get to the target events. So this might be shocking to you. You might go, what? But see, the trick is to figure this out so that the risk size you actually increase, and you allow yourself to increase your risk because your positioning is much more precise, right? If I know that I've got some kind of great pitcher and he's saying, I can thread this, or let's say it's an archer, right? And, am I the one that's going to put an apple on my head if William Tell comes to shoot it? Probably not, because I don't want to die. Not yet. I mean, it's okay if I die. I know where I'm going, but I'm not ready to go yet. There are a lot of things I want to do with you guys first. So risk, very, very important. But realize this, we have to outsize our general risk when we're working in these accounts. So in order to do that and still end up on the right side of everything, we have to become very good at strategic implementation, right? I suggest 2 to 5%. 50K still would be pretty small, right? 2% then works to, $40, and 5% works to $100. But it can be done, right? If you move up to 100K, your drawdown's $3,000. That's more of an event that you can trade with. But it teaches you, if you learn how to do it this way, it teaches you tremendous patience and the ability to leverage in once your XFAs and live trading accounts get larger. You can really multiply gains. That's why so many of these guys on the leaderboards are making gobs of cash, because they figured this out. I'm going to risk a little until my account size grows, and then I'm still going to risk a little, but now I've got the power of compounding in my favor. So use fixed dollar stop. This framework came from a compiling of some very well-known prop firms that are out there, not like Top Step, which is, not quite a prop firm, but working on the same thing, getting you to that space. So they used a lot of fixed dollar counts based on the ATR times the tick value or market structure. I say, just look at market structure. It's going to tell you the entire picture. And you won't have to do any other calculation. You just draw a box. For me, I like drawing a box, right? So for your daily loss, I say 3 trades a day. If you go down 3 days in a row, 3 trades in a row, it means you're not looking at the market the right way. Step back, take the generated information, and say to yourself, I think I need to adapt. I think I've got to make some adaptation about what I'm doing. And then avoid overlapping trades or compounding losses by doubling down or re-entering quickly if you haven't established whether that cycle event is ideal. So, what should we do here moving forward? Next time, we're going to sit down and go through what market structures look like. Listen, we know it's simple. Uptrend, higher highs, higher lows. Downtrend, lower highs, lower lows. But when you take a big framework and you go, I wonder what trend it's in a 4-hour formation. All right, let me look at the last 3 swing highs or swing lows. Let's say you want to swing trade something because you've got other types of accounts and you're trying to make money in a trading account here that you can use to invest in other things. That's a great idea. Range movement, it's going to be sideways, but here's the thing. They're also going to overlap each other in types of market structure. And we validate them by the sequence in the swing points. Does old resistance become new support? And so on and so forth. All right, so done with that. What I want to do is open it up for questions and go through a couple of examples and then realize the number one thing is this. My goal tonight was to tell you about how to position stops, right? How do you position stops? Why does a stop seem logical in a particular space? And then if you look at the stop and you go, okay, I see what that stop should be. Let me see if I can take this trade. Now you know, all right, I know it's about the market structure. Let me just wait it out, see how it holds on. I know how it looks from the hour. I'll go to the 5-minute. I'm going to trade the 5-minute. I'm going to watch for price action telling me that nobody's going down. And I know this number is based on a bigger profile. I'm in good shape, right? I'm in good shape. Now, here's another thing that you can look at. You can look at something and go, well, here's a structure break, low, high, lower low, retest of the high, and then a lower low. Literally, you could come in here and go, wait a second. I think I could take that short from here to here. Now, it's going to be better if you do it here because that's the first market structure break after that initial move, right, on the 5-minute formation. So that first structure break is always going to give you valid information. At the end of the day, delete all your boxes. Do not get attached to the lines that you draw because somehow, they're your babies and you need to put them to bed. Start all over. It's going to build strength. It's going to build your ability to look at something and go, nope, that's a structure break. We have to wait until the market tells us where it's going. For instance, here's the following. I'm going to remove this. Let's take a look at what might happen at 6 o'clock when the market opens in just, 2 minutes, right? Here's what's going on. We have a low, a high, a higher low, and a higher high. Structure break from the hourly before, still in range. But now we are staring down the newest 5-minute formation. We're still stuck inside of the entire range of the day before. What does that tell us? Ultimately, we could go all the way back down here or we could go up here. Look at the 50% line of the market structure, right? This is the line we want to hold. If we hold this line and we break out over this edge, if it allows us to come back and test it, we get to have a trade. And that trade is long. And we can have our stop here, probably. It might get wicked out because that's pretty noisy, but that's what's telling us. If I hold the 50% mark and I'm making a low, higher low, higher low, higher low, high, higher high, higher high, if I hold that level up here, I can take the long. Look what's happening, right? So my long immediately invalidated. Why? It's underneath the 50% mark and it's in a bunch of mess. If I want to take the long, I must wait for it to get up and over this structure. Otherwise, it's going to give me another piece of market information, right? So what is that piece of market information? I don't know. It's in the middle of another structure event, right? This is the low, this is the high. On a 5-minute, it's sitting right in the middle. Right in the middle. If you take the trade and you go, no, I want to go long, ultimately, if you hold it until it goes long, your risk is all the way down here. Bad choice, right? If you go, oh, this is a place where maybe I can use my stop as my entry point. Maybe. But your stop better still be right under it. But this is invalidated, right? This is completely invalidated. Why? I have a high, a low, and then a lower high. And so in that 5-minute, it's now sitting inside of that other structure. So it's telling you literally it is a coin toss. Literally a coin toss. Hopefully that makes sense. My thought would be, all right, I'm either going to take the trade if it gets above this zone. I don't like trading the first hour of the trading day anyway. I like for this entire Globex hour to completely do its thing before I decide what I'm going to do. So, but clearly the long is invalidated. Why? Not over the 50%, so it doesn't matter if you go, oh, I want to take it anyway. If your probability of the trade working out is invalid or counter trend and you run into the stop, if you have to outsize your risk in the top step environment, which you have to, unless you are absolutely perfect with execution or you end up being very, very good with strategy over the long haul, you've got to manage that risk. You absolutely have to. And if you've got a poor strategy setup, don't do it. Don't say, hey, listen, ooh, look at that. I'm just taking the... It could be that that is the place, but the trigger point to go long is above it. Because this structural break says, hey, I lose 50%, I'm just going to wait for it to go. But that would be where you would position a long. If you say, hey, I'm going to position a short, well, you're in an upcycle, so you could have taken the short as soon as it started rejecting that 50% line of the motion. But then what? Well, you got another structure break here, so that's an overlap. You've got another structure break here, that's an overlap. You could easily run it down, but when you sit inside of a lot of structures, you're going to see candlesticks retrace each other. All right, so now I'm going to, if any of you want to, am I only doing 3 trades a day? I do a lot of trades a day. Trading on the Top Step platform is something that I do occasionally, simply because I've been trading for so long. I have my own accounts that I run. So, yeah, I say limited. I say limited trading in this environment is very, very important. It's incredibly important, to be sure. All right, so let's see what kinds of questions we have here. I set my personal DLL as follows: 20%, funded 10%, but I have to say I started trading with fear. I start trading with fear if I take a couple of losses. My position size is such that after 3 losses in a row, I hit my daily loss limit. After the second loss, I'm very fearful. Causes me to either move my stop loss to break even. Any suggestions? Well, your risk level is too high. So you might go, come on, man, it's not that bad. You've got to size down your risk. Can you go back to the slide that defines proper setups, how markets define proper setups? All right, let's do that. All right, types of market structure, where are we? Defining proper setups, core components of risk. I don't remember what that is. Where is that? Proper setups. You mean risk management defined? Yes, I'll give you guys a copy of this afterwards. Do I have a minimum target of risk to reward? I do not, because I am intensely focused on market structure. Sometimes market structure gives me 5 to 1. Sometimes it gives me 1 to 1. Right? See how it breaks the edge of this space and then tries to come back in? You will often see that when a price action event is very messy. Yes, you can tell when a market is going to give you a tape bomb. Look at the opening range here. This opening range tells me tape bomb central. Tape bomb central. The whole environment. If I looked to any kind of space where I see the morning have a big range, there's a tape bomb on the horizon. Any kind, any time there's a range expansion event, there's a tape bomb coming in one way or another. Why? Because inventory appreciates and then liquidates, right? They accumulate and then distribute. Am I opposed to trailing stops? Listen, if a trailing stop works for you, I'm not going to say don't do it. I don't like them. What is my direction? What is my definition of a structure break? A structure break is very clearly defined as a break of price at the bottom of a swing low or a break in price at the top of a swing high. For instance, let's use what's going on right here. Here we have a bit of structure. Let's put it 5 minute. Here is a swing high and a swing low, right? That's those edges. Swing high, swing low. A market structure break is when it loses either the edge of the swing low or the edge of the swing high. Notice, because the price action is generally sideways, both of these structures revert to the center of the noise. How do I know that's likely to happen? My hourly chart, 1, tells me that I literally, look at how long I've been sitting in the same range. What is this date? Let's take the market structure back to here. Right? High to low. What is that actually? Up here. Right? Since I forgot my camera's on and I stuck my tongue out right there. Sorry. This is, what day is that? May the 1st, right? I don't even know what day of the week it is right now. Is it May 7th? Right? For 7 days, we've been sitting in the same range. 7 days. So what do I know? If I break out of a range and I collapse, I'm likely to come back into the range. And now what we're doing is compressing price, right? We've got lower highs and higher lows. We're getting ready to have another very big move in the market, I think, right? I think we're going to have another big move in the market. So let's keep going. Yeah, it's super clear. Don't go complicating it. Listen, The only thing that complicates these kinds of trades is if you try to do it on a 1 minute, or you try to tick every single high-low. Listen, they're all right. But unless you're scalping 1,000 contracts, which I would not recommend, you're going to find yourself with so much noise that you cannot make a decision. Less is more. Every single time, every single way, less is more. If you can manage building structural shifts on your 15-minute, you'll be even better for it. It'll help you tremendously. It'll slow down how many trades you take, because remember, if you're going to be a good trader, you need to document each of your trades, why you took them, what the structure was, what your risk was, how much you got out of it. And that's easy by putting, your trade reviews up on your screen and then taking a snapshot of it. But you have to know what you did. So next time you can go, I saw this 50 and I thought that this might be a base. And so I think I had a pretty good shot at a long. I just didn't want to take the risk. Next time, I might do it, but structural risk is always going to sit in your space if you don't stare it down properly. And it's going to come and bite you in the neck, right? Who wants to get a bite in the neck? So that's it. Any other questions? Good idea to have a max risk on the day to avoid tilt. Just to confirm. Oh, I was just thinking of you. Just to confirm, we would wait until the first hour of Globex Open to establish the opening range for the day. Yes. Now, if you listen to Hogue, a lot of the guys at Top Step who came from the floor, except for Hoop thinks just like I do. A lot of the guys that came from the floor, they want to look at 9:30 to 10:30, the actual regular trading hours Globex. Me? No. I want the first hour of trading. I want that high-low, and I want to set it up. So what we can see, and I'll do it this way. Let's remove all the drawings and let's remove all the indicators. This is the last thing I'll show you. All right, let's go backwards. I want you to see how well this works. And how do you establish profit targets for a day? Don't worry about establishing profit targets. Worry about, oh, thank you so much. I appreciate you watching them, my morning video reports. Here's the thing. Don't think about profits. Think about process. Set a trade strategy and follow it. Because here's the thing. If you're a world-class MLB pitcher, you're not going out there thinking, you know what, I'm going to do 12 strikeouts today. I'm going to do 5 strikeouts today. That's not what they're focused on the mound. What are they focused on? Process, control, consistency, mindfulness, understanding the environment around them, knowing the batter who's come up and what it is that he has trouble hitting around. These are the things that you think about, not at all about your profit targets for the day, at all. Manage your loss, focus on your process, and the profits will come. Manage your loss. That's a very important threshold, because if you run out of money, you're either going to have to buy another combine or fill your account back up. So manage your risk, focus on your process, and the profits will come. I promise you. Listen, I was an abysmal trader when I first began. Abysmal. And now I am a very good trader. I have people calling me all the time going, hey, listen, can you come on our show and talk about this? Can you come on our show and talk about that? Why? Because I sat down and I followed a process, and those people have been staring at me for 10, 15 years going, okay, well, I guess she knows what she's talking about. So focus there. And I'm not trying to jump on you, I don't want it to feel that way. Here's my thing. My goal is to bootstrap each one of you into success. but I can't drag you. I want to hold your hand and walk with you, but I can't drag you. And I definitely won't drag you. But some things are just going to be hard to hear. Way too many of us think about profit targets. Now, I'll be completely straightforward. Do I think about, hey, it'd be nice if I could make, 2-3 grand a day. I won't have to draw down from any place, and I can do this, that, or the other, right? That's perfectly fine. But am I looking for that number so I can get out of the market? No. I'm looking for the execution of good process. That's it. And what we have to do is not drift from one strategy to another because, oh, that didn't quite work for me. Focus on something that resonates to you. A lot of people trade moving average crosses. I can't do that. I just look at price. Is it going up? Is it going down? Is the picture telling me that there are more sellers? Is the picture telling me that there are more buyers? And then I just follow along where I think it's the cheapest. I'm going to go for the sale, right? I'm going to wait for it to get on sale, and then I'm going to buy it when it's on sale. And that's going to be at the bottom of these breaks, okay? Let me see for any other question. Do I have a minimum target of risk reward in your trade? Oh, I answered that. No, I don't. I just follow the market structure. Am I opposed to trailing stops? Not for me. For me, yes. I can't say that for you. You might have a nice way to do that. I don't have a set profit target today for the day, but I feel like it's a hindrance because I'm not managing my outsized winning days properly. I become too comfortable with taking what would usually be outsized risk. So, as devil's advocate, if we look back at that sentence and I say to you, manage your risk, focus on the process, and the money will come, and you just told me what it is that you're doing as having a profit target, what rules are you actually breaking? Rules that I just defined them. I'll tell you. 1, outsizing risk. It's got nothing to do with taking a profit target. 2, if you outsize your risk, it means you're not sticking to a process. If you're not sticking to a process and you're outsizing your risk, you're going to give back a ton of money every day. Every day. So the question then becomes, okay, I'm going to stop trading when I cannot focus completely on process anymore. For me, listen, I do a face plant every night. And in general, I don't trade past 2 o'clock. Why? I've run out of all my mental capital. It's gone, kaput, got nothing. And if I can't completely focus, okay, what's my structure looking like? Making higher lows, higher highs. How can I sit and take a look at this? If I can't continually string my thought processes together, I go, I'm too tired. I'm getting out of here. Okay, my issue lately has been slowing myself down so I can think logically and not impulsively. My neurodivergent brain struggles to shut everything else out. I feel you. I am also neurodivergent. I sit on the spectrum. I didn't get diagnosed till I was in my 30s. Totally understand the noise event. So here's the thing. If you go, you know what, I can't seem to slow down. When we have a lot of influx, one of the first things we need to do is say, I got to shut that off. I hate I'm going to miss that, but I got to think. I don't know if you can notice. You can't see it because the light to my camera is very good. My office is essentially dark. It's literally dark. And I have it like this all day long. I turn it on if I'm on camera because it just looks better. It doesn't look like I'm in a dungeon. But you can see off to the edge of my image, and you'll see that. Let me open this one. You can see that behind me to the, what that would be? It would be currently my left. See how dark it is there by my bookcase? My office is dark. I need it dark. And I need it dark because it calms me down. I have to cut everything out. I have to cut everything out. And so it feels okay to go, listen, I'm just going to chill. I'm going to start with small things and I'm going to block everything out and get it done, because the most important thing for me to get solid on this journey is making sure I've built myself a process that I can lean into when I don't feel emotionally strong or psychologically strong. I can go, you know what? I know how to do that. I'm just going to lean into my process. And it's always very visual. Always very visual. All right. When balancing consistency with performance, what do you think about taking trades with modest risk reward versus holding for outside wins? Do you lean on more structured, high probability setups? Or do you size smaller and aim to capture extended moves when structure allows? Yes. All of those, because here's what happens as you develop as a trader. You have several market baskets or trade baskets that you can look into and go, I'm going to use this strategy today. This one's going to work pretty effectively. So by and large, I like them structured. I like them high probability, but more importantly, I like them structured and low risk. I don't care if they're high probability. I like them structured and low risk. Sometimes that low risk gives me kabam. Sometimes it doesn't. But what I know is I'm focusing on how much I don't lose. My problem is I just keep flipping from long to short. I just need to sit on my hands. So the question is why? Why do you do that? Because you don't know where the market's going. I don't know where the market's going either, but I could tell you, looking from the market structure, what's likely to happen and how I can position myself in a trade based on that. Right? So, yeah. And see, someone said, hey, I just feel like I'm missing out. Listen, it's very hard to watch the party from the outside window and feel like, I could just go inside. But then, it's just before they call the cops. So that storyboard right there about missing out, listen, what you want to build is a self-confidence that says, I know what I'm doing. If this trade doesn't work out, I've established my risk threshold. And it's okay if this loses because I've managed the risk internally. But see, what we do is we study so hard to get the right setup, and we take the trade, we go, it's got to absolutely win. Because if it doesn't win, then somehow I'm a failure. I don't even know how to read anything. And we can't do that to ourselves. The epsilon, or the risk or error factor, is always a part of markets. It's statistical noise. That's what epsilon is. And statistical noise could wick us out. But what do we need to know? If I get wicked out, I know exactly how much I'm going to lose. I know exactly how much I'm going to lose. And that's all that matters. It could move continually upside and I can raise my stop through the market structure on a nice day. But what I absolutely know is how much I'm going to lose. I have no idea how much I'm going to win. But I have complete control over how much I'm going to lose. So you better believe I'm going to be all over that, like white on rice. I'm going to be all over the only thing I can control. Do you use Bollinger Bands? I use volatility bands, though not as much. What I use now, and if you look at my morning video in the morning, you can see I use implied volatility measures because there's so many known unknowns in the market that the majority of big money traders are leaning in to those implied volatility moves. Was the real turning point in your trading when you stopped chasing setups and oh my gosh, Board Yeti, you got it spot on. Absolutely. I stopped chasing the chart, stopped chasing price, and I waited for it to come to me. And I knew if it came to me, my risk was low. That's absolutely right. And what it gave me was a peace. I can't tell you how nervous I get when I'm on screen with Dakota, or I'm listening to Dakota and he goes, I'm long, I'm long, I'm long. I'm like, wait, what just happened? What did I miss? So it's just that I just need to go, I'm going to let this come in, and I'm going to let this, I'm just going to, listen, I'm a slow thinker. I'm a deep thinker, but I'm a really slow thinker. And so I need that slowness to go. That's why I love the Globex opening hour. I love that formation that says, all right, this is telling me what's happening. If we go higher, we're going to have a structural break up into the volatility moves. If we go lower, we're going to have a structural break into the lower support edges. And by structure break, of course, I mean just the lower edges of the prior structure. So the big move that I'm thinking is this one that we have to really think about. So last thing, I know I said that 10 minutes ago, but this is really it. If we look at the structure break here, you can see we've really worked hard on holding that 55.92. If we lose it, gonna be ugly. I think we go back to the lows of whatever day that was, right? So that, I would say, is the big thing to watch in the ES. Now, next time, no, my morning videos aren't, oh, yes, they are there. Golly, I totally forgot they were there. Yes, of course they're there. Yes, on YouTube. And I thank you very much for putting that up, Board Yeti. So, again, bring your questions. Next week, we're going to go full bore into strategy setup, how we look at the market structure, how we set up the trade, how we go from big time frames to small ones, and then position some stuff that looks pretty good. I was trying to think about when we could do it live, but that would be really kind of late, and I do church on Wednesday. So I'm so happy that you liked it. I really am happy. I do want to feedback. Whoa, what happened right there? I did get a question, and they said, hey, what do people say about you as a coach? I'm like, I got no clue. I got no clue. So feedback is great. Super glad that you guys liked it. I will get the PDF off and tag it somewhere. I don't know how to do that. I can't. I don't know how to work Discord. I'm so sorry. Thank you so much, everybody. I appreciate it, and I'll get the video up. It's going to take a while for it to compress, and then we'll be off to the races. I appreciate each of you. Time is the only thing we spend that we have no way to get back. And the fact that you spent it with me means very, very much. I don't take it lightly, and I appreciate you. All right? Take care, everybody. I'll see you soon.